If you're thinking about rolling your pension into an IRA, stop right there. This one decision could either cost you hundreds of thousands of dollars or set you up for a worry-free retirement. Here's what most people don't realize. Many financial advisors will push the rollover hard, not because it's right for you, but because they earn more when you do it. I happen to be a financial advisor, and although my sons wouldn't allow me within 1,000 miles of their money, I do have a few satisfied clients. I'm making this video because I've seen too many people get pushed into rollovers in situations that ended up hurting them. I recommend a rollover from a pension occasionally, but that's really not maybe as often as you would think. So today, I'm showing you exactly when a pension rollover makes sense and when it doesn't, because here's the thing. Once you make the choice, there's no going back. Now, most advisors will show you spreadsheets and projections to justify the rollover, but here's something those spreadsheets cannot capture, something that changes dramatically as you age, and it might be the most important factor of all. I'll show you exactly what I mean in a few minutes. But first, let's walk through the hidden costs and the real motivations behind the advice you're getting about rollovers. Let's start with why advisors push them so hard. Here's how the business model works. If your pension stays with your company for your life, your advisor makes $0. But if you roll over $500,000 into an IRA that they manage, they typically charge, let's say, at maybe 1% per year. That's $5,000 annually. Over 20 years, it's $100,000 in fees from just one client. So when an advisor tells you you should roll this over for more control and flexibility, ask yourself, control for who? Flexibility for who? And do I really want all that? Because here's what they're not actually telling you. When you roll over, you're not just gaining flexibility, you're taking on all the risk. Market crashes, that's on you. Withdrawal mistakes, that's also on you. Outliving your money, that's on you as well. And of course, those fees paid by you. Now, does that mean rollovers are always wrong? No. I've recommended them when they make sense, but that's only in a small amount of cases, and we'll get to that later. Here's what you're really giving up when you roll over a pension with some actual numbers so you can see it clearly. The first hidden cost is longevity insurance. Your pension guarantees you a paycheck for life, even if you live to be, let's say, 100. That's longevity insurance, and it's incredibly valuable. If you tried to buy that same guarantee in the private market, like maybe a lifetime income annuity that pays what your pension pays, it could cost you 20 to 30% more than the lump sum they're offering you. For example, you're offered $500,000 as a lump sum or $30,000 per year for life. To buy a $30,000 annual annuity privately, you need $600,000 to $650,000. You literally cannot replicate your pension in the lump sum amount. That's hidden cost number one. Hidden cost number two is the fee drain. With an IRA, you're paying fees every single year. So we can be conservative and say maybe 1.5% annually, which would include advisory fees, fund expenses, and trading costs. And stay with me on this because these numbers really matter. A $500,000 rollover at 1.5% per year is $7,500 in year one. Over 20 years, even as your balance declines from withdrawals, you're still looking at $60,000 to $80,000 in cumulative fees. Meanwhile, your pension, zero fees. You get 100% of your benefit every month for life. Here's hidden cost number three, market risk and sequence of return risk. So this is really the one that keeps me up at night. When you roll over, you're exposed to the market's ups and downs, which can be very harmful, especially early in retirement. So if you retire in a bad market year and your portfolio drops 30% while you're still taking withdrawals, you might never recover. That's called sequence of returns risk, and it's devastating. People who might have taken a lump sum in 2007 and retired into the financial crisis, they could have seen their portfolios drop at least 40% while they were still taking withdrawals, and many never recovered from that. Your pension doesn't care. Market crashes, inflation, living to 100. The company bears all the risk. You just keep getting the check, as it were, every month, no matter what. So let's recap what you're giving up. Longevity insurance worth $100,000 to $150,000 more than your lump sum. Zero fees versus $60,000 to $80,000 over 20 years, complete protection from market crashes and outliving your money, at least for that portion of it. And what are you getting in return? The ability to leave money to your kids, maybe, and the flexibility to manage your own retirement income, which most people don't actually want. Here's some situations where I would recommend a rollover because they do exist. There's not many of them. Situation one is the payout rate is terrible on your pension. If they're offering you for a $500,000 pension, like a $18,000 payment, that's 3.6%. That's below what you could safely withdraw from your portfolio. They're kind of lowballing you. So in that case, you would consider taking the lump sum. A fair pension payout is typically, let's say, 5 to 6% of the lump sum annually. So anything below 4.5%, that's when you should seriously consider a rollover. The second situation is you have serious health issues. So if you have a documented medical condition that significantly shortens your life expectancy, that lump sum might provide more value and stability for your family. But you got to be honest with yourself. I don't think I'll live that long. Doesn't count. I'm talking about real documented health conditions. The third situation is you have other sources of guaranteed income that cover your baseline expenses. If you're Social Security, if there are annuities, if there are other pensions that cover your housing, food, and healthcare, and this pension is truly extra money on top of that, then you might have some flexibility to take more risk with it. But here's the reality. Most people facing this decision don't check all these boxes, and that's when keeping the pension is almost always the right choice. Let me show you what this looks like with two real people, John and Sarah. They're both 65. They both have the same pension offer, $500,000 lump sum or $30,000 per year for life. John keeps the pension, Sarah rolls it over into an IRA. So let's see what happens over a 20-year period with Sarah's money in the IRA. She withdraws $30,000 per year, and we can assume a rate of growth, let's say 6%, average return over that 20-year period. So in year one, she withdraws the $30,000. She pays $7,500 in fees, roughly 1.5%. Year 10, the balance is around $380,000. She's still withdrawing that $30,000, still paying the fees. In year 20, the balance is around $180,000. The total she's received over the 20 years is $60,000. Fees spent, let's say about $68,000. The remaining balance is $180,000. Now, she does have $180,000 left to leave to her kids if she doesn't live past, let's say, age 85, but she paid $68,000 in fees to get there. John, on the other hand, he got the same $600,000 over 20 years, but he paid zero in fees, and if he lives to 95, he gets another $300,000. If he lives to 100, that's another $450,000. Now, this is the part that most advisors won't tell you about, and a spreadsheet can't show you. Studies suggest that nearly half of retirees experience anxiety about spending in retirement, spending their retirement savings. Sarah is part of that statistic. Every market dip, every withdrawal decision, every year, she has to rebalance and manage that IRA or stay on her advisor to do so. It adds stress. And John, well, he sleeps at night. And here's the thing that I mentioned earlier that spreadsheets can't capture, something that changes dramatically as we get older, and that's our ability to handle all this. What do you actually do with this information? So there's 3 steps in my book to help you make the right decision. The first step is to calculate your payout rate. So what you do is you take your annual pension payment and divide it by the lump sum offer. For example, $30,000 per year divided by $500,000 would be a 6% payout rate. If that payout rate is 5% or higher, that's a pretty decent pension. I would probably suggest you keep it. If it's below 4.5%, the company could be lowballing you. So you might want to consider the rollover. The second step is to get an opinion from a fee-only fiduciary, not someone who earns a commission on the rollover, not someone who manages assets for a percentage. A fee-only advisor who charges you a flat fee for advice and has no financial stake in your decision. This is just too important to trust someone with a conflict of interest, even if that someone is me. Number 3, ask yourself the honest question. Do you really want to manage this money for the next 20 to 30 years? Do you want to worry about market crashes, withdrawal rates, and outliving your savings? Or would you rather have a guaranteed paycheck that shows up every month no matter what, so you can actually enjoy retirement? For most people, the answer is obviously that the pension wins. So let's bring this home. I know that this is a big decision, and I know there's pressure coming from every direction: advisors, family members, people who mean well, but might not actually understand your specific situation. If you need help thinking through all of your different options regarding pensions or anything else, that's why I created the Securement Review specifically for you. It's a fee-only service. There's no commissions, no sales pitch, just an objective analysis of your numbers and your situation. You can learn more at theretirementguy.com. If this video helped you see through the noise, hit that subscribe button for me. I make videos like this every week to help you retire smarter, not just richer. Here's another video I did on pensions. It's right up here. You might enjoy it. And thanks for watching.